Welcome back to Gecko Finance channel. This is Artie and let's go. Today I want to discuss a very important and also interesting topic. That is how prices on the market form. Let's get right into it. You've probably seen all those charts and all those things in the news where prices on the stock market rise and fall, and sometimes they rise unexpectedly and also fall unexpectedly, and no one knows what's happening, right? You've probably seen that South Park episode where they cut off the chicken's head and then it runs around the circles, and where it lands, that's what determines the price. Yeah, it may look like that if you don't really understand what's going on. Our task today is to explain what is actually going on the market. There is such a phenomenon as depth of the market. In many ways, it resembles a glass, the one that's either half full or half empty. Our glass is half filled with those who want to sell and half filled with those who want to buy. Let's imagine two lines of people. The first line thinks the market price is too high, so they want to buy shares for a lower price. The other line thinks that the market price is too low, so they want to sell their shares for a higher price. And they are all standing in line to the market price. The closer their price is to the market price, the closer they will stand to the beginning of the line. And here comes our buyer, who wants to buy 100 shares for the market price. But the first seller is willing to sell 20 shares for, let's say, 100 euros. The second seller is willing to sell 50 shares for 101 euros. And the third seller is willing to sell 40 shares for 102 euros. Our buyer gets 20 shares for the price of 100 euros, 50 shares for the price of 101 euros, and 30 shares for the price of 102 euros. So our market price raises from 100 euros to 102 euros. And here comes our seller, who wants to sell shares at the market price. He's willing to sell 100 shares. The first buyer wants to buy 10 shares at the price of 99 euros. The second buyer wants to buy 40 shares at the price of 98 euros. The third buyer wants to buy 30 shares at the price of 97 euros. And the fourth buyer wants to buy 50 shares at the price of 96 euros. Now our market price drops from 102 euros to 96 euros. Is it possible to buy shares now at the price of 96 euros? Not really, because there won't be any sellers who will be willing to sell their shares for such low price. What should you do in this case? Wait for buyers and sellers to show up with the right price. Otherwise, you will lose a profitable offer. Why do new offers appear on the market? There are a lot of reasons for that. Influencers' statements, news, changes in legislations, changes in government, Reddit, all of that makes people think that they could buy or sell their shares at better price. Usually investors believe that some assets will grow in price and some companies will develop and increase their profits. It could be profitable for them to invest into bonds, shares, you name it. If the demand increases, the supply increases too, just like in the regular market. But what should you do in this case? Should you jump on the bandwagon and start buying or selling? If you are playing over a long distance, those small fluctuations are not very important for you. It's much more important to follow long-term strategies of the company. It is way more important for you to follow long-term strategies and plans of the company. These indicators are much more valuable than those little changes that we've just discussed. Anyway, depth of the market analysis is very important for traders, but if you want to play over a long term, it can help you understand when it's better to buy shares and when it is better to sell them. Well, that is it for today. Like, subscribe, leave a comment and ring the bell. Earn money, multiply money and be happy. And remember, the world is not all about money, but about its quantity. See you later, guys.